Okay, we might have everyone now, but normally people will drift in. So hi and welcome everyone. Good to have you on. Beautiful day here in Wellington. Cold but beautiful and everything. I've just had a few weeks in the UK actually, so that's why this um, meeting is a little later than it would ordinarily be. But look, let's get into it. As the headlines show there, to the end of June 2026, unfortunately, things aren't getting better. We've had a bad few months in the Wellington real estate market overall. Bad from a perspective of sellers, not bad for buyers, amazing for buyers. Um, so we are again at new post-peak low value in the value on the value side of things. The message to sellers is that the sales volumes um, and values have fallen further. You have to be very, very competitive. You have to present your place well, and you have to price your property competitively if you are going to get traction. Um, so this is not a market to where you test the market or see if you can get frothy prices. You have to be genuine seller in this market. And buyers, you have unbelievable choice and negotiating power in the market today. So let's get into it. Median sale price 750,000, exactly the same as it was a year ago, so no change. Again, I keep harping on about this, but look at the red line that shows you the overall trend. You can see that the big correction is definitely behind us, but the last couple of years has still seen very gradual erosion. Now, this is median sale price. It doesn't indicate value reliably, so I don't like it particularly as a KPI, if you like, but you still can see, nonetheless, a trend there, slow erosion of the median sale prices. So as I say in the starburst there, the major correction, no doubt, is behind us. That happened in 2022, basically. But there is remaining weakness that is still with us in the market. So yeah, it's not a picnic out there. Let's look at the Real Estate Institute House Price Index. So you can see there 29.1% down in the Wellington region versus the peak in late 2021. That is a new low, as I sort of indicated at the top. Auckland, pretty bad also, not as bad, but not miles behind it, almost 25% down. So Wellington region roughly back to the values that we were at in March 2020, just as we were locking down. So way back to before all of that huge value growth that we saw. It's all been undone. And in actual fact, in the city, we are back to November 2019 values. So those numbers you see there on the screen, that is Wellington region numbers, so 29.1% down versus the peak. If we looked at Wellington City is actually 30.1% down versus the peak. So, yep, we have reached new low points, unfortunately. Over the last 12 months, again, Wellington suffered the largest annual decline at 4.5% down. And goodness me, over the last 3 months, almost the same. So it's been a bad 3 months, 4.4% down in just 3 months. That's pretty horrible. Auckland, not all that far behind it, down 3.6%. And indeed, you can see that the same theme is throughout the country overall, 2.4% down across New Zealand. So um, one has to conclude perhaps it would be too coincidental that this has coincided with the trouble and the geopolitical tension in the Middle East and the arising inflation concerns and so on. Now, obviously, we've seen the inflation readers come out, and it's not looking all that. It's not great for 4.1% or whatever it was. But the about half of that, I believe, was petrol. So if you take the petrol out, it's just over 2%, which is in the band. So inflation is is turning out to be, so far at least, not the major story that people are worried it might be. And so maybe people's concerns will ease. Maybe that will have implications for interest rates not having to go up as fast and so on, which obviously causes a lot of concern for buyers. But nonetheless, look, the facts are the facts, and values have definitely suffered in the last 3 months in particular. So if you look at this graph, you can see there that orange line is telling a really clear story. That has been falling off a cliff in the last 3 months. So things were actually looking pretty respectable. We were recovering from sort of winter last year, a year ago. Things were heading in the right direction, and then the last quarter it absolutely fell off a cliff. So as I say, to me at least, too much of a coincidence to be happening at the same time as in the aftermath of the Middle East conflict. But in terms of looking at the data, as I say in the Starbase there, this is the biggest 3 month decline we've seen in the Wellington region since all the way back here in January 2023. I mean, it came close a couple of times here, as you can see, but we are down below those markers there. So, yep, no question about it. It has been a rough few months in terms of underlying values and the real estate market in general. Wellington City. As you can see there, values in Wellington City in the last 3 months have fallen even further, 5.3%. Now that we don't have to go back as far as January 23 to see a time where the city values have dropped to that degree. That happened in kind of early spring, late winter 2024 here, and also in mid 2023 and indeed early 2023 as well. So the city tends to be more volatile. It's a smaller data set. We see bigger highs, bigger lows. So that's not all that surprising to see these other troughs, if you like, competing with the trough we're in now. But it's still, nonetheless, it's it's a big drop there, and you can see that is a precipitous fall there in the last few months in Wellington City. And there it is in terms of the actual house price index numbers themselves. So you can clearly see that after the big drop here, after late 2021, we saw a recovery heading into the election last time. Since then, broadly speaking, we have continued to see an overall trend of very gradually eroding values. Quite a big sort of period of stability there, and there were some signs that the market was starting to improve. But as I say, since the conflict, if indeed that's related, and I suspect it probably is, just playing in the minds of buyers in particular, we've seen definitely a noticeable tailing off there of values. So those decline in values are clearly visible in that graph there. All right, let's get into some of the detail of the data. New listings volume, so 490 in June versus 483 a year ago, 532 2 years ago, about the same as a year ago, slightly down on 2 years ago. Now, from a seller's perspective, what we want to see here is new listing volumes tightening. We want fewer new listings to compete with. That makes it easier to compete or to get our property seen by the buyers, to get the attention of the buyers. If there are more new listings coming on, then that makes the job much harder. So that's not a bad story, this one in and of itself. We can see that new listing volumes down on 2 years ago and about the same as a year ago. That is not a negative story. Look at the red line showing the 6 month moving average there. It bounces up and down a little bit seasonally, but for the last 2 years plus, we have been operating broadly in a normal range between 600 and 800. Slightly at the lower end of that range, but nonetheless, I would still call it fairly normal. So this isn't painting a negative picture in terms of the supply volumes coming to market. So stable versus last June, down versus June 24. And there is the June average, 522. So at 490, we're actually a little lower than what we typically see in a June. So again, from a seller's perspective, that's positive. It's not deeply lower. But what are we there? It's 30 down, so that's going to be about 6%, 5 or 6% less than what we typically see in a June. So in the absence of any other data, you would say that's a positive sign for sellers. And there you can see it compared to 12 months prior. New listings coming to market over the last 6 months have been broadly stable compared to the year prior. On the other hand, the number of sales taking place, and this is where we do get a bit of a negative story, 520 in June versus 580 a year ago and 501 2 years ago. So we actually saw more sales than 2 years ago, but 10% fewer than a year ago. And I often find, again, that looking at that red line, that shows us the overall trend, and I think here it's quite instructive. So in 2022, we fell to really horribly low levels. We were recovering quite nicely. We were recovering consistently for a good 2.5 years or so. But about 15 months ago, we started to falter, and since then, there has been a gradual, gentle erosion. But that red line has gotten steeper over the last 3 months. So yeah, as I say there, sale volumes definitely trending down recently. And you can see there the 6 month average, the first 6 months of the year, on average down 7% versus the first 6 months of 2025 and down 2% versus June 2024. So first 6 months to June 2024 is this period in here. And so, you can see it's around about here, that red line, and so we're ever so slightly down below it at this line here. So that's the snapshot. But again, as I say, the trend to me is more useful. The direction of travel is often more instructive than the actual gross quantums themselves. So to me, that trend is fairly clear. And there is the June average, 636. So yes, we've seen a trend of slightly reducing sale volumes, and we're also at volumes that are actually quite low for what is typical in June. So typically 636 in June and 520. That's 18% below what we typically see in a June. So there's no question that whilst new listing volumes are coming to the market, typically, in normal levels, on the sales side, things have dropped away again, and those two things combined, of course, do not go together to bring good news for sellers. Again, there it is. You can see that trend of deteriorating sales volumes. We were in positive territory for some time, and then whilst we were still in positive territory, again, the direction of travel was negative, and that trend has continued to be consistently down below the parity, the x-axis, over the last 8 months or so. How long is it taking to sell? Again, you look at that red line, the direction of travel is absolutely unambiguous. We were heading to reasonable territory sort of down here after we saw massive drops in the duration to sell. That again was heading into the election last time. Since then, it has been progressively just generally becoming longer and longer. Obviously, it's a few bumps here and there, but the trend is unequivocal there. So it's taking much longer to sell than normally is the case in Wellington. And again, you can see June average 41 days, and at 56 days, we are significantly longer than what is typically the case, and 2 days longer than a year ago, and 7 days longer than 2 years ago. So again, the trend is unequivocal. Even if you look at it from a 6 month average, 54 days versus 48 a year ago, 42 2 years ago. Oops. So yeah, the trend there is clear. It is taking a long time to sell property on average in Wellington. Inventory, it's the same story. We saw inventory come right down, significantly down, as we headed into the election last time. Since then, the trend has been broadly increasing. As I sort of indicated before, we had a period of time where the market was quite stable. Over the last 6 months or so, we have seen increasing, but that red line has definitely steepened. The gradient has increased in the last 3 or 4 months there again, coinciding with the Middle East conflict. So 18 weeks worth of supply versus 13.6 a year ago, 15 2 years ago. We got positive numbers here. It's longer, it's longer, it's longer, it's longer. The trend is, as I say, inescapable. Long-term average is 15 weeks. We're significant. We're considerably over that, 20% or so over that. But over the last 11 years, which is of course what we all remember, it's been 10.8 weeks, and we are 68% above the average that we have typically seen since 2015, which is, I mean, 11 years, a long time now. So pretty hard for any of us to remember before then. So plenty of inventory out there. Again, not good news for sellers, great news for buyers. Trade me listings. You can see there the blue lines show month-to-month results. So this, of course, is July. It's as of a day or two ago when I sort of compiled all the data. So that, as you would expect, shows volumes of listings on the market decreasing. Even though we've seen sales pulling back and listings coming on being consistent, we always tend to see, because the new listings being consistent, it's being consistent with what we typically see at this time of year. The new listing supply always comes down as we come out of daylight savings and head into winter. And so you can see that translating also here into the gross listing quantum, if you like, the gross listing volumes that are on the market. It has reduced the last 3 months as we headed into winter. But overall, the red line is showing a continued trend upwards. So that's kind of smoothing out the seasonal variations. And that red line, as you can see there, the 6 month average of 3369 is higher than we have seen basically since I started collating this data. So again, for 11 years, we haven't seen sales volumes, listing volumes at this level for this time of year since before 2015. So yeah, it's been a long time indeed. There's more choice for this time of year than we've seen for over 11 years. And there it is in the different format, comparing it to 12 months ago. So you can see there we were heading to parity, and in the last little bit we have just seen the divergence between this year and last year. That gap is starting to widen again, and hence you're seeing that red line sort of sneaking upwards. So this is a fairly consistent story. The market has broadly deteriorated in the last few months for sellers, meaning it's harder for you to get your attention to your property. The pullback has mainly been, or the difference has mainly been on the buyer's side. There seems to have been an erosion of confidence from the buyers, and that is coming through in fewer sales taking place, duration to sell taking longer, and relative supply increasing again. So in summary, folks, values have been declining. Wellington City is now just over 30% below the peak in nominal value terms, according to the house price index. New listings are broadly stable with a year ago and slightly below what we typically see in June. Sales volumes, on the other hand, are definitely weakening, down 10% from last June, and significantly lower than what we typically see in a June. Selling times are long, 56 days versus a June average of 41. This is significantly longer than normal. Inventory is elevated, so we're well above the kind of what we typically have seen over the last 11 years. Trade me stock is high. We're at the highest July level for at more than 11 years. I can't tell you when it was last. I suspect it was for 12 years because my data only starts in 2015, and prior to that, for the few years prior to that, so stock was even higher than what we saw. It was coming down when I started to collect the data. So the message for sellers, as I've said, sort of a few times throughout this. Pricing is critical, presentation are critical. You have to hit the market quite hard and be pretty serious about it if you want to gain real traction in the market. And the buyers, look, it's a great time for buyers in the market. Their choice is exceptional. Negotiating power and value are exceptional at the moment. So I wouldn't be holding back if I was a buyer. And indeed, I am intending to buy in the next 12 months. I personally have sold two in the last 12 months that I've owned in partnership with other people so that I create some headroom for myself in terms of my borrowing capacity. So I'm able to purchase some, better quality properties on my own instead of in partnership with other people. And I've recently given instructions to an agent to actually list another property that I own with my sister overseas, that one, to basically unlock a bunch of capital, hopefully, fingers crossed. So I'm able to enter the market here. Yeah, I think if you're a buyer out there, the buying is just exceptional at the moment. Big thanks as always to Real Estate Institute and realestate.co.nz for the data. But if any of you have got any questions or you want to have a chat about anything, then I'm all ears and happy to discuss. Just unmute yourself and yeah, jump in.
I've just got a question around the last 3 months. So you mentioned it's dropped quite a bit. Do you think that's a direct correlation to the fuel crisis? Because that would seem to be the trend.
Yeah, well, as I say, I've sort of kept referring to the timing of the Middle East conflict. Um, so that introduces a bunch of nervousness in various respects, doesn't it? It's the whole uncertainty of gosh, what will happen as a result of this? But you're probably right that the bigger implication, given we are about as far away from danger as we possibly can be, it will be the inflation in fuel prices initially, which makes us feel very bad. I mean, I heard some data which said something like the proportion on average of a household's budget that goes into fuel is some ridiculously small number. It's 2%, 3%, 4%, something like that. So if that value increase, if the price increases by 50%, then 2% goes to 3%, 3% goes to 4.5%. It doesn't crush the entire household budget, but it is something that's very visible. We drive past the signs every day with those numbers. We pull into the station every week or every 2 weeks, and it's a number that we get used to. And when that number's going up, it makes us feel bad as much as anything. But then there's the flow on also, of course, of the increased fuel prices throughout all the other value chain and the supply chain of all other things with a delay, of course. And then following on from that, if that produces inflation, which is sustained, then the Reserve Bank have to increase interest rates, and so mortgage rates would follow. So a general concern, a fear that that was the track we're going down amongst the buyers will most probably, I would suspect, yes, have a section of buyers, at least a portion of buyers, sitting on their hands because they're too nervous about the risk of what might happen in the future. People always hate uncertainty. People hate risk. So in that situation, yeah, a bunch of people will decide, no, I'm going to pull back and wait and see what happens. So, yep, 100%. I think so. Yep, good question. Anything else for anyone else? I mean, and so on that note, I mean, if indeed inflation continues to come through as not as bad as what people were expecting, and with any luck, although, gosh, it's a roll of dice, isn't it, with what's happening over there in the Middle East, even from one day to the next, let alone from one month to the next. If fuel prices are hopefully kept under control, then it looks like the balance of the economy is actually producing inflation that is within the Reserve Bank's band, and that would bode well for interest rates and therefore to support an economic recovery in general, and of course confidence, which goes to your point. Anything else for anyone else? No, that sounds like we're done. Hey, thanks for checking in, guys. If any of you want individualized advice, obviously happy to help. You know how to get me, Adam at Low& Co. Otherwise, have a great month and see you next time. Bye.
Thank you.
Cheers.